It was just announced that the Federal Reserve would be cutting interest rates, a move that will no doubt help virtually everyone whenever it comes to the cost of borrowing money. But in the short term, what does this actually mean for you, the consumer? Let's dive into it. Just today, the Federal Reserve announced that they would be lowering interest rates by 25 basis points. This officially makes this the first cut of 2025. This is a relief for many people, but especially the Trump administration, who had been applying pressure to the Fed to cut rates since the Trump administration entered office back in January. But given the fact that the labor market is showing signs of distress with a not-so-great jobs report recently released, and the fact that inflation is still creeping higher under Trump tariffs, it actually wasn't a surefire thing that this was even going to happen, even though many experts and reports were hopeful that it would be the case. A rate cut, I mean. But again, this does beg the question of what does this really mean? Well, unfortunately, not much, at least yet. Unfortunately, when it comes to rate cuts, the impact we feel isn't with the one single rate cut, nor does it appear like the flip of a switch. Instead, the impact of rate cuts really stem from multiple rate cuts over a period of several months or even several years. Or sometimes even rates can fluctuate depending on the anticipation of a Fed cut. For example, mortgage rates. While mortgage rates have improved in the last few weeks and a Fed cut no doubt is positive for the mortgage market, the Fed does not directly set mortgage rates. Instead, those typically move in tandem with the yield on a 10-year Treasury note. So investor activity with the 10-year note depends on how they feel about the economy, so they may increase the buying of the 10-year note, which lowers its yield. And since bond price and yield move in opposite directions, this then lowers the 30-year mortgage down, which then decreases your interest rate if you're someone buying a house. So mortgage rates don't actually go up or down with a Fed cut or a Fed rate hike. Instead, they go up or down or react based on anticipation, very similarly to how you may see stocks react whenever there's a specific company that's about to report earnings and they expect for those earnings to either be very good or very bad. But a different example is car loans, which have a very less reactionary relationship with the Fed. Car loan interest rates are tied to longer-term Treasury yields, and as we see here today, these Treasury yields are still higher, thus driving interest rates to an inflated level. So car loans aren't going to have that immediate reaction regardless of what the Fed was going to do, whether they increase them or decrease them. So almost the exact opposite of mortgage rates in a way. And so what this means for the car market is that at least right now, car interest rates are not going to change significantly, at least not with this specific announcement. In a few months, you may see a difference, and with more rate cuts, you will absolutely begin to see an improvement. In fact, for those of you watching this video who may feel a bit frustrated because regardless of the good news that we see, we just don't see it move the dial whenever it comes to affordability of vehicles, you got to check out this stat because this is encouraging. According to Cox Automotive, nearly 7% of consumers financing new cars at dealership in July locked in 0% APR. By late July, the average loan rate for a new car was 9.06%, which was down 61 basis points year over year, and for buyers with credit scores above 760, the rate was down to 5.4%, which is the lowest level that we've seen since September of 2022. And so we have seen some massive improvements whenever it comes to the accessibility and affordability of car loans and interest rates in the car market. And that is excellent news. And with the tide hopefully turning whenever it comes to interest rates, with this being the first rate cut with hopefully more to come, we should see some even greater improvements in the coming months and in the next year. Now, this certainly is not bad news, and whenever it comes to the car market, you really couldn't ask for something much better. However, if you are someone who is wanting to buy a car and you've been waiting for the right time to make that purchase in order to get the best rate as possible, you really have two different options. Either wait roughly 6 months to a year in order to make that purchase until interest rates have gone down, or you could potentially buy a car and then refinance it, or alternatively, you could explore another way to get a better interest rate. For example, rather than waiting for rates to fall, you may be better off keeping an eye out for a killer incentive from a dealer like those 0% APR you mentioned earlier. You could potentially go with a credit union, which have historically offered really aggressive rates, especially compared to more traditional banks. Or you could potentially look to improve your own credit rating, which will ultimately yield the biggest impact on your interest rate that you may get with a vehicle purchase. At the end of the day, this is great news. And I sure hope that this is the first of many cuts to come, and the first of 3 that we hope to see in 2025. Because as of now, we have 2 more potential Fed cuts that could come this year, with the final 2 meetings of 2025. The next one is on October 28th and 29th, and the next one after that is on December 9th and December 10th. 10th. So whenever we look at the potential of where rates could go, we could see at maximum 2 more cuts, 2 more hikes, or a mix of both. But I know that I have my fingers crossed that we will have 2 more hikes between now and the end of the year. Like always, you guys, I hope that you enjoyed this video. If you have any questions, comments, if you have anything to add, I would love to hear it. So make sure to leave a comment down below. And while you guys are at it, make sure to hit the like button, hit that subscribe button, and hit the notification bell. And I will see you guys in the next video.